Yesterday, the Fed put out their latest SLOOS survey that gives an X-ray to what's happening inside banks, and it is grim. The SLOOS, Senior Loan Officer Opinion Survey, measures how tight credit is, which is a proxy for how the economy is doing, and most important, it tells us where are the risks. In the survey, bankers reported dramatically tighter standards, meaning they're hogging cash, despite weaker demand for loans from commercials and industrials, meaning those companies are afraid to invest at these rates. Now, tightening was sharpest in the commercial real estate sector, a regional bank mainstay, which is being gutted, especially in the big cities where rents and values are plunging. I've got a video on this a few weeks ago, how the rise of crime and remote work means people don't want to pay $1 million to dodge poop and bricks to the head, and are decamping to happier climes, leaving trillions in empty office and retail space for banks to lose money on. In raw numbers, the SLOOS showed 3 out of 4 loan officers are tightening lending, and 4 out of 5 are actually increasing spreads. So they're charging more for loans, even on top of their soaring cost of borrowing freshly printed money from the Fed. Presumably, the banks are charging higher spreads to cover both higher risk and to help staunch the bleed to money markets. The end result is starving the productive sector of capital, a key driver of a serious recession. Of concern for those regional banks, standards tightened hardest for the housing and developers that make up a big chunk of their assets, coming to roughly 85% of officers tightening. Meanwhile, of concern for all of us, lending was loosest on consumer loans, credit cards, and installment credit. Given credit cards just passed 24% annual interest, that's according to Forbes, there is a reason bankers get along so well with gangsters. This is painting a picture of banks swapping out solid loans, building real things, for usurious predation on people buying groceries on installment. Now, none of this bodes well for the banks. Real estate loans are $5.5 trillion of bank assets, while business loans are another $3 trillion. So that's $8.5 trillion of exposure, set against the total capital buffer in U.S. banks of, according to a recent Stanford study, between 200 and 500 billion, so 20 to 40 times smaller. That is a tiny sliver of assets, perhaps at this point no assets at all if, quote, unrealized losses were accurately reported, trying to carry $8.5 trillion in rotting loans. Note that's not even counting another $2 trillion in potentially subprime consumer loans, including those 24% credit cards, plus another $4 trillion of government bonds, which have been rode hard and put away wet by the Fed's rate hikes and are now in the crosshairs of the debt ceiling standoff. Toss in several trillion more that banks gamble in currently volatile financial markets to try and window dress ahead of the reaper, and there are a whole lot of plates spinning. The only thing keeping them up there is money printing, which, between the Fed's fear of inflation and the soaring federal deficits driving that inflation, could stop at any moment. Okay, we'll be watching. See you next time.